Hey everybody, what's up? January 28th, Tuesday. Alright, let's talk about what's going on. Market rebounded a bit today, but we were selling into the rally. Let me talk about a couple of things. It's all about money, right? You've heard the expression, money makes the world go around. It's all about money. It's all about these flows, fiscal flows and credit. That's what drives everything. Now, credit is really a function of demand. And you could say fiscal flows are a function of demand too, is what the non-government demands from the government, really. So the government doesn't have that much control over the amount of spending because it's the non-government that demands those dollars, and you see those flows coming into the economy. But two things that I have been mentioning recently. Number one, credit demand slowing down, and we've seen this in the metrics. We've seen it in loans and leases, particularly in commercial and industrial loans where the growth is almost flat year over year. I mean, it has really had a precipitous deceleration in a very short period of time. But now it's kind of trickling over into consumer loans. I spoke about that yesterday in the video that I made. The other thing I want to talk about, or the other thing that I've been mentioning, is this, the reverse stabilizer effect. And that's where now you actually have tax flows going to the government that are increasing at a faster rate than the spending flows. So you think about this as income transfers, right? When the government spends, it transfers income to the non-government. When the government taxes, that's a transfer of income from the non-government back to the government. Now, what we've had over the past few years, and what has been very beneficial for the economy and the stock market, we've had positive transfers. In other words, the government was spending faster than it was taking away in taxes. That's why you saw the deficit go up. And by the way, let me make a point on the deficit, because today, and write this down, because I'm telling you this now when nobody else is telling you this. It's another one of my, Mike Norman scoops that you hear first and then you hear it later on. The CBO, the Congressional Budget Office, said that this year the deficit is going to surpass $1 trillion. Remember, last year it came in just below $1 trillion, I think 965 billion or something like that, and that was like the highest deficit in 7 years. So this year they're predicting the deficit is going to go over $1 trillion, and I'm telling you that's not likely to happen. And how do I know that? Because the recent trend in the deficit shows a shrinkage in that year-over-year gap. In other words, the amount that the deficit is up this year compared to last year has shrunk dramatically. It's only up by 10 billion over last year, whereas at this same time last year, it was up 120 billion over the previous year. So we're shrinking. We're going the other way. So remember, when it happens and they say, hey, guess what? We didn't hit $1 trillion deficit. You can say, well, Mike Norman told us that a long time ago, because that's what I see happening. But that's important because that equates to our income flows, or those income flows that I was talking about. That's slowing down. So if you think of the government as like a money pump, pumping money into the economy, right? That's spending in excess of taxation. That goes to somebody. That goes in somebody's pocket. That goes to a firm's profits. That's slowing down. So you have credit demand slowing down, which is probably linked to the slowdown in the growth rate of government spending. You have the government spending slowing down. So the economy, remember I said, I don't predict where the stock market is going to go. I don't predict where the markets are going to go. I forecast basic conditions of the economy, because once you know, and somebody said to me, Mike, you got great stuff. I just, it's not something I can use. Oh, really? Like, yeah, okay. Understanding what the basic trends in the economy are, yeah, that's not really valuable information. That's not useful at all. Like, we don't need that, okay? It's better to just guess what's going to go on. I mean, come on. Give me a break. That is the most important thing that you can have. So yeah, conditions are, I'm not saying they're deteriorating badly or rapidly, and maybe this is a pause, but like I said yesterday, the evidence is building up. The evidence is building up that the underlying conditions are starting to get weaker. And when you put that against a backdrop of a stock market that has just gone parabolic, especially, look, let's go back to who's getting into the stock market now. All last year I told you the neutrals were sitting on the fence. They were sitting on the fence, watching the market go up, watching the market go up. No, we're not going to get in. Watching the market record high after record. Now we're going to sit on the fence. And then in the last few weeks, hey, we're jumping in. Everything is great now. We're jumping in. So this is the distribution. This is the strong hands to the weak hands at a time when underlying conditions are starting to weaken. There's a strategy for this. You have to know what this strategy is, because big money can be made on this. Big money can be made on this, but you have to know what to do. Go to my website. The link is right here in the description below. Sign up for a therapy. Unless you don't care, I mean, you can guess what the economy, like the guy said, it's not really something I could use. You know, the basic trends of the, that's not important. I don't know how to use that. Gee, I don't know how to use that. How would you use something like that? I don't know. Gosh, I don't know. Check it out. Go to the link right here in the description. Sign up for a 30-day free trial of MMT Trader. Somebody said, hey Mike, your thing is getting expensive. It's not expensive. What is expensive? Expensive is when it brings you nothing, when the cost is greater than, the investment. Look, people said that at $75. They said it at $100. They said it at $125. They said it at $145. They said it at $195. They said it at $250. People are signing up at $395. It's going to $1,250 a month. Get on board now. See you tomorrow. Bye-bye.